Shifting your overall equity allocation from neutral to overweight, which is the preferred market for risk, emerging or developed, and why?
We like the emerging markets primarily. They see 5% GDP growth. Generally these countries have better balance sheets than many of the developed nations, and these markets trade at about a 10% discount to historical norms. However, we also like the United States. In the United States, this market is a lower beta market. It's supported by the Federal Reserve, which is willing to backstop the economy to some degree. And we see some earnings momentum in the United States, which makes it an attractive market for us.
How does China stack up among emerging markets?
We like China, we like South Korea, and we like Brazil in the emerging markets. But I would say that China right now represents the greatest opportunity. Trades at a discount to historical valuations. And of course, as you know, in China, we're really starting to see better economic data due to the infrastructure investment that has raised confidence and also economic growth.
Which sectors in China would you recommend?
Well, we look globally at the sectors, and of course, as we see the economic growth increase, we're moving more towards cyclicals and industrials. However, our favorite markets overall, I would say, are technology and healthcare. Technology trades at a historic discount to usual valuation metrics, and healthcare provides some long-term opportunities based on growing demographics and aging populations, both in China and the West.
With earnings coming into full swing in the U.S. and in the early stages in Asia or China, what are the prospects of these earnings seasons for Asian and Chinese companies?
I think that that's a really good point, and it's one of the reasons we're not completely overweight in equities, and we also have an overweight in corporate bonds and high-yield bonds. And while the economies are improving, we're not seeing, outside of the U.S., we're not seeing that increase in earnings momentum that we would like to see before we get really bullish on equities. And it's a sign that the global recovery is overall going to be relatively modestly paced and slower than normally out of a recession.